Have you been avoiding UK stocks because they seem stuck in the mud? Well, you're not alone. The FTSE 100 has lagged behind global counterparts in recent years, posting a mere 13% gain over the past 5 years, while America's S&P 500 has soared by 88%, and even Europe's Stock 600 has climbed by 36%. It's been a rough ride for UK equities, as they've been battered by political turmoil, sluggish growth, and a lack of exciting new listings. But here's the twist: the tide could be turning. Big asset managers are ramping up their exposure to UK stocks, and institutional investors have flipped from being net sellers to net buyers of UK equities over recent months, according to the Financial Times. This shift is massive, as it reverses a long-standing trend. But what does it mean? Is this the moment for UK stocks to shine? Are we on the brink of a comeback, or just another false dawn? Well, in this video, we'll be deep diving into exactly that, and we're going to break it down into 3 parts. The first part will be focused on why the UK stock market is suddenly more attractive. The second part will be focused on the obstacles that can still hold us back. And the third part will go through our conclusion of whether it's time to jump in. So stick around, because we might just uncover a good opportunity. If you're new here, I'm Alex, a management consultant by day, and on this channel we like to discuss all things personal finance with particular focus on how to grow your money. But for this video, let's get into it, and let's start with why the UK stock market is suddenly more attractive at the moment. The most obvious reason is a more stable political and economic environment. Over recent years, our political landscape has been incredibly unstable, with 4 prime ministers in the last 4 years, and markets don't tend to like political uncertainty. However, now with Labour's landslide election win, it seems we may be returning to at least a few years of political stability. We may also be returning to economic stability, with recent economic outlooks suggesting cause for optimism. The Bank of England have increased its growth forecast for the UK economy to 1.25% this year, up from its previous estimate of 0.5% in May, whilst UK interest rates have reduced for the first time in more than 4 years, from 5.25% to 5%, and more rate cuts are possibly on the cards before the end of the year. Of course, a stable political and economic environment isn't enough alone to drive growth in the stock market, but it certainly provides a better environment compared to what we've had over recent years. Over the last few years, we've had red-hot inflation, a series of aggressive interest rate hikes, and plenty of worries over economic growth. This was likely one of the key reasons to why many investors have neglected the UK stock market. The impact of this neglect has been pushing UK stock market valuations to exceptionally cheap levels. And this brings me on to the second reason why the UK stock market is seemingly attractive at the moment. And that's the fact that the market fundamentals are in our favour. The most common valuation metrics all suggest that UK stocks have been relatively cheap for a long time. For example, if we take a look at a basic price to earnings ratio, the Shiller P ratio, which divides the stock price by the average of a company's earnings for the past 10 years, then we can see the UK stock market has a much more attractive PE ratio compared to the US. And since 2009, that gap has only been increasing. It's not just a US effect either. UK stocks are trading at a discount compared to Europe as well, showing that they're cheap relative to their international peers. Some may argue that this data is misleading, as it's backward looking and doesn't show future growth prospects. But even if we look at the forward price to earnings ratio, which accounts for future earning forecasts, the UK still looks very cheap and significantly below the US and Europe. Even if we dig deeper into industry comparisons, we can see that most UK industries trade at a discount relative to US peers. For example, the UK energy sector is valued at 7.1 times the next 12 months earnings, whereas the US energy sector is valued at 11.1 times the next 12 months earnings. This difference equates to a 30% discount between the UK energy sector and the US energy sector. So it's clear that UK stocks are relatively cheap by valuation metrics. But given they've been cheap for a number of years, this alone is probably not enough to tempt investors. So you may be thinking, well, how could this change? And here we go back to reason 1. The difference now is that we have a stable political and economic environment, and this may just provide a catalyst for investors to refocus on the positive attributes of many UK listed companies and the valuation attributes of these companies. In fact, this is exactly what the UK Chief Investment Strategist for BlackRock suggests. He states, although the UK equity valuation was clearly attractive, we lacked a catalyst to go overweight. The potential for a more stable political environment provides this. This leads to the third reason why UK stocks are currently attractive, and that's the fact that there's renewed institutional investor interest. As we found out at the start of the video, institutional investors have switched from being net sellers to net buyers of UK equities since May. This is a combination of many large fund managers beginning to increase their positions in the UK stock market. For example, James Thompson, manager of a $4 billion Rathbone fund, now has his largest holding of UK equities since 2016 at 6%, whilst BlackRock, the largest fund manager globally with 10.6 trillion under management, moved to an overweight position on UK stocks in early July. This trend may become even more significant over coming years, as the stability of the UK may become prominent compared to other developed countries, with potential disruption in the US under a second Donald Trump presidency, and France and Germany facing unstable coalitions. The combination of stability and attractive valuations may make the UK a relatively safe bet for institutional investors, which could spur performance in the UK stock market. What reinforces this thought even further is the fourth reason why UK stocks are seemingly attractive, in that the bleak period of a lack of new listings may be changing. A number of global companies have recently announced plans to list on our stock market. For example, Vivendi, the French media conglomerate, have announced plans to list its French TV business, Canal+, on the London Stock Exchange. An even bigger win would be the Chinese fast fashion company, Shein, which recently filed initial paperwork to begin the process of a listing. Despite ethical concerns about Shein as a company, if you only look at the financials, this could be a huge listing, with the company potentially valued at 50 billion. If they pull that valuation off, it would put them in the top 15 of the FTSE 100 by market cap. This, along with Canal, are huge wins, as these companies could have listed elsewhere and followed the trend over recent years where many companies have done exactly that. For example, the British semiconductor company ARM recently opted to list on the Nasdaq instead of the FTSE 100, despite many British politicians lobbying them to try and list on our stock exchange. This trend has led to the UK stock market mainly being weighted towards slow growth companies such as banks and insurers, and companies which face challenges to their long-term prospects such as oil and mining companies. However, hopefully this trend is beginning to change. This is important as renewed interest in listing on the London Stock Exchange could bring optimism back to the stock market, particularly if listings are from high growth companies. So in summary for part 1 of this video, the combination of a stable political and economic environment, attractive valuations, renewed institutional interest, and the potential for new listings makes UK stocks certainly seem more attractive. However, it's also important to consider potential obstacles to this, and in the next part of the video we'll focus on what may hold back UK stocks. One obvious obstacle is a lack of retail investor optimism, particularly among UK residents. The Financial Times suggests that retail investors continue to sell out of UK equity funds, withdrawing nearly 1.8 billion in May, which was a record monthly amount. The reason for the lack of optimism may be associated with some of the topics we touched on earlier, such as political and economic instability, which could improve with recent changes. However, there are likely more fundamental reasons for this neglect, and one of these is a lack of incentives for retail investors to put money in UK companies. There were plans under the last Conservative government to provide an additional tax-free ISA allowance when investing in British companies. Given there are 800,000 people in the country that currently maximise their existing 20k allowance, if all these people were to take up the additional allocation, that would add 4 billion into our market, which is a sizable sum. There were also proposals to encourage pension funds to invest more in the UK market. However, with a new government at the helm, it's unclear whether either of these plans will come into fruition. At the moment, investors are likely disincentivized to put money into UK companies because of taxes, since we have a 0.5% stamp duty on UK shares, which is higher than peer nations. If this were to change along with other incentives for UK investors, it may drum up more interest. But until it does, retail investor neglect will likely continue and be an obstacle to UK stock market performance. The next obstacle is a lack of business investment in the UK. The UK has had the worst rate of business investment among the G7 for 24 of the last 30 years, while new investment coming in from those outside of the UK in the form of foreign direct investment is at a 12-year low. This is a key barrier to growth as investment fosters innovation and progress, and a lack of investment has likely contributed to the current productivity problems and skill shortages in the UK. If we don't solve this, it will likely provide a future barrier to economic growth and potentially hinder growth in the UK stock market. Labour have suggested that increasing business investment is a key priority, with Rachel Reeves, the UK's new Chancellor, vowing to turn Britain into a safe haven for business investment. So let's wait and see if progress is made here. Another obstacle is the composition of the FTSE. Although there's a sense of optimism about new listings, the composition as of today is dominated by sectors such as oil, tobacco and banking. The companies within these industries may be multinationals making billions in revenue, but they're often lowly rated by investors. There's also a lack of companies in sectors which are currently highly rated by investors, such as technology. Tech stocks have boomed this year amid a frenzy over AI, but the UK stock market hasn't been able to benefit too much from this because we lack AI and tech companies. This is not to say that there's no UK-based tech companies, there are many, but unfortunately many recent high-growth UK tech companies have chosen to list elsewhere, such as Arm. We can only hope that new listings lead to a slight change in index composition, bringing in more high-growth companies. We're certainly moving in the right direction to encourage this, as we've just had the biggest overhaul of stock market listing regulations in 40 years. The changes were focused on making it easier for higher growth and founder-led companies to list on our stock market exchange. These changes need to continue to ensure the composition of companies on the FTSE has a balance of high-growth companies to complement many of the stalwarts already there. So in conclusion, the UK stock market presents a promising opportunity with enhanced stability in the market, with attractive valuations, renewed institutional interest, and the potential for some exciting new listings. However, challenges do remain, with low optimism among retail investors, a lack of business investment, and a composition to the index which is weighted towards slow growth industries. If the current government and specific regulators are able to address these challenges, particularly in providing incentives to investors and providing regulatory reform to encourage more investment and more exciting new listings, then this could lead to a turn in the UK stock market and it could lead to growth. But the question is, would this be a temporary upswing or a long-term trend? That's for us to find out. Thank you for watching the video, and I'll leave you with a quote from Warren Buffett.